The Dow, S&P, and the NASDAQ all about 2% from their highs. Savita Subramanian is the head of U.S. equity and quantitative strategy at Bank of America Securities, and she joins us live this morning. Savita, you were looking for a price target not much higher than where stocks are right here for the end of the year. But you do say there's upside risk to that.
I do think so. I mean, look, we're at a point that is frustrating because sentiment is not necessarily bearish or bullish based on all the things we look at. Positioning in stocks, I would say, is still relatively light compared to what one would expect after this really strong market rally. So I'll give you one number. If you look at all the brokers across Wall Street and you look at what they're recommending their clients put into stocks, the allocation is 56%. To me, that doesn't sound like euphoria. That sounds like, we're legging into the market, but we still got a lot of cash, still got a lot of fixed income on the plate. I think what could happen next is if we have a Fed that is likely to hold rates steady or start cutting. And I mean, our team thinks the Fed doesn't cut until next year. But let's just say you look at real returns on cash and bonds. I mean, and I've said this before to you, it's not great compared to inflation prints. And I think you start to see a rotation out of cash into equities, probably the yieldier equities in the S&P 500.
And you like stocks better than you like bonds at this point,
I do. I still do. I still think we're in an environment where the real risk is country risk. The equity risk premium is actually quite low, and I think it should be because companies have figured out how to navigate policy uncertainty. Like, what was remarkable to me is that during this period of tariff uncertainty, I was expecting a lot of companies to pull profits guidance, like do what they did during COVID. We had a fairly steady flow of information. Transparency was good. Companies said, we can handle tariffs, just give us some numbers. And now we have some numbers. So I think that you could start to see economic activity pick up. I think the other reason to be bullish on activity, and maybe not markets, is the idea that when you look at all these transcripts and listen to what these companies were saying, they weren't canceling projects because of tariffs. They were delaying them. And that means there's a lot of pent-up activity in the pipelines that could start to materialize in the
What
next
about the
few
weakness
quarters.
in the labor market that we saw last Friday?
So, yeah, I mean, I think that we're all a bunch of nervous Nellies, and when we see a bad jobs print, we're like, recession, recession. I don't think we're heading into a recession. I think what that's telling us is that wage inflation might be cooling a little bit, which is actually great for corporate profits. So, one print does not make a negative trend. I think that we're an investor group that is very primed to expect something bad to happen because we've had such strong market returns against such a crazy macro backdrop. But when you look at corporates, they're well capitalized. They've prepared for higher interest rates. Their debt is long-term, fixed rate, low levels of debt. The S&P 500 could actually, be more healthy than it's been in a very long time from a balance sheet perspective.
What about people who say we're at these high valuations, things are getting expensive?
Frothy, yeah. I mean, I think that's probably true in areas outside of large cap U.S. equities. I mean, I do think that the risk is I can't find a single investor that is outright bearish on AI. And I feel like we've all been forced into this AI theme because that was all that worked in July. Now nobody is naked AI, and what if we start to see some disappointments? I mean, these companies are spending a ton of money on CapEx. They're cutting into their free cash flow. I think that's the area of risk in the S&P. And even there, these are companies that aren't trading at the tech bubble-like valuations. So it's hard to say sell the market. I do think we're probably likely to see, a 5 to 10% pullback. But I don't know if a bear market and a recession are really the base case. I think that it's more likely we see an economic boom because there is so much pent-up capital that has yet to be spent on infrastructure, power, grid. Like all this, this sort of building stuff in the U.S. hasn't really happened yet. And I think that might be the driver from here.